Good Tuesday afternoon to you. Wonderful to be here with you, and a very warm welcome from all of the team here at AusBiz. So it is the 6th of August, and boy, do many investors out there feel a bit battered and bruised. We will discuss that, plus 10 stocks and a stock of the day with my excellent expert guests. Joining me in studio, Mark Moreland from Teaminvest. Hello, and Shawn Hickman from Market Matters.
Hi.
Nice to see you guys.
Hi.
Look, we have to talk about what's going on out there. Shawn, it's been pretty painful. It's not over yet, is it?
I think it's been volatile more than painful, Nadine. I think one has to take a deep breath and stand back. Mark and I were talking about this before we came in. What does normally happen this time of year? I like my stats, I like my numbers. Over the last decade, the pullback between August and September, top to bottom, is an average is 7.25%. We haven't done that yet, okay? The mode is very close to that. It's got a low standard deviation. The market tends to pull back at this time before getting ready for a Christmas rally. I hate to be flippant. It does that. Last year we pulled back over 10%. The previous year we've pulled back over 10%. The market's not doing anything unusual. However, it's doing it a lot quicker.
Yeah.
And the carry trade unwind in Japan is the catalyst for that. There has been masses of money coming out of US dollars and Australian dollars back into the yen. They're not so much buying the yen as they're unwinding what they had.
Yeah.
The Bank of Japan has raised rates. We've suddenly had this huge view that the US is going to not just cut rates, but slash rates. I mean, this morning on Bloomberg, the preferred scenario was a 0.5% cut next month, not even a quarter.
Yeah. Well, we saw firmer data out last night, so we'll see how this conversation evolves. But what you're saying is keep calm and carry on. I will, though, at the end of the program, get a stock, because there have been real beaten down examples. What you would buy if you got it on great sale.
Just let me finish. That's all I've been writing about to our members today, is take a deep breath. Quality stocks are coming back to good areas. Stocks you wish you'd owned all year, and you were too pedantic on price, they're coming to you.
Yeah.
You know?
It's exciting, actually, the
It's
opportunities
really
that get
exciting
thrown
as
up
long
by
as
the
you're not
volatility.
leveraged long.
Yeah, that's what we're here for. Mark, you are Mr. Berkshire Hathaway. What's up with the divestment of half the Apple stake?
Well, all we can do is speculate. He clearly doesn't need the money, and then you say, why would he do it? Now, my theory, and that's all it is that he may be considering a very, very, very large purchase, which wouldn't be buying shares in something, it would be an outright purchase. It could be an insurance or something like that, where he's going to take out a $200 billion business or something. I can't see, knowing what I know about him and how he thinks and what he's always done historically, that I can't see what else it could be. Because they always have to carry a fair amount of cash because of their super cat insurance liability, so they need to be able to cover big claims, which we were talking about. So that's probably, he used to say 30 billion, it's probably 100 billion now. Okay. It's not 280 billion. Yeah. So it's, and also Apple, he said at the AGM this year, is the single best company in their portfolio. So by definition, if Apple's the best company in the portfolio, why would you sell half of them? And he sold Bank of America down as well, which is also one of their long-term holdings. But he's still the biggest shareholder in Apple, by the way. So he hasn't sold out.
Yes. Yeah.
But he's raising money. Why? I can't see what else it could be.
You have any theories?
No, I ponder that, could he be looking at surprise everyone and go more into tech? He was slow getting on the tech bandwagon, but he's gone on, he's held, he's done extremely well. I think the acquisition makes a lot of sense. I wouldn't have a clue where he's going to go. It's not my field, following what he
we were
does.
talking about that at the AGM this year, because when he sold down 10% of Apple. Even then it was like, why?
Yeah. Okay, well, look, we have a program that we've got to get to, but I did want to ask you both about that. Let's get to the stock of the day. It is...
The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
Our stock of the day is Treasury Wine Estates. The winemaker has updated the market, telling investors it will book a $290 million non-cash impairment after tax in its upcoming full-year results. TWE also saying it will divest its commercial brand portfolio, which includes Wolf Blass, Lindemans and Yellow Glen, which in FY24 only represented less than 5% of its gross profit, 5% I should say. Treasury Wine says it will focus firmly on its luxury portfolio with an update on its future operating model to be part of the FY24 result announcement. TWE says that its earnings will come in line with expectations at $658.1 million before material items. So, Treasury Wine Estates up by 1.5% off the back of that news. So getting out of those sort of lower margins, less popular brands, is that a good strategy?
It has been. We're long Treasury Wine, so I'm a bit biased. We like the way they've evolved their business. Obviously, after it had its legs cut off when China closed the doors, they've evolved very well into the US, and I think as a business, they've done a good job of that. I think the market got ahead of itself about how well China was going to let wine back in, and they built on too excessive earnings. But I think going forward, we're long, we like the stock, and we think it's going to outperform.
So you would be buying it now?
Or? At these sorts of levels, I'd be comfortable buying it. The risk reward's good. It's not very good. It's not what I'd say heavily underpriced, but we're very comfortable to hold it.
Thank you. What do you make of Treasury Wine Estates?
Not much. I agree with what we said about China. When they bought them Penfolds at the time, I thought that was unfortunate. Not for them, but for Penfolds.
Yep.
So what they've done, this is a process that companies go through. They buy up, they grow by acquisition, and then you end up then shrinking to greatness again. So you go, oh, it's not working, so we'll sell all the consumer, the lower price brands, if you like. It's probably not that they're not popular, it's just not, they can't make as much money out of it, and which is fine. So you go through this stage where share prices go up based on acquisitions, and then share price at the moment is going up based on disowning or
rationalisation.
Rationalisation, that's the word, right. So look, if you look at the numbers, its return on capital is only 5.6. We have a minimum of 10%, so it doesn't hit it. It doesn't pass our screening, so we would never look at it. If I look at it from a return point of view, it's still currently on a PE of 25.8. Its EPS growth rate average for the last 6 years has been negative 4.9, and sales have declined at 1% over that period. So it's pretty ordinary. Now, what Shawn was saying is, well, they're positioning now to go better. Well, they may well, but from a price point of view, 25 PE is way too high for a company that's really in a turnaround situation, in our view. So if you look at it from a return point of view, what our models show is that if you bought it today, you're going to get a negative 0.6% return per year over the next 5 years, which is not exactly exciting. And if you wanted to get 10%, which is minimum you'd consider, in my view, you couldn't pay more than $6.98, and it's currently $11.59. So that's how we look at it.
I think I did say I didn't think the risk reward was attractive just here.
Yeah. you can change it to a hold. It doesn't have to be a buy today.
Absolutely.
Okay?
I'm not saying it's a bad company. No. I'm just saying, it's.
I'm staying with a buy, but we're holding it. We're not adding to it in this market. Okay. We're not adding into the pullback.
Got it.
That PE, by the way, is in the green, which is in the bottom quartile of its normal range. Treasury's always had a high PE.
Yeah.
And then the question is, that's fine if it's justified.
Yeah. If the Chinese start drinking wine, you'll see it at $14 quickly.
Sure.
Yeah.
That's our stock of the day. Stay with us.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.
Well, let's get across the companies that you've nominated for our guests to talk about today, and that is Hansen Technologies, Hazer Group, Objective Corporation, Chalice Mining, and Bellevue Gold. Boy, Shawn, I don't think there's going to be many on the list that you're loving there, but let's get right into it. And the first stock picked by you is Hansen Technologies. This is for Ron. What do you make of it, Mark?
It's a business we've looked at numerous times over the years, and so it's come up on our filters, in other words, which is why we look at them. It's a company that looks at manages billing for utilities, but they also do telcos and so on as well. It's a global business, Australian based. Market cap's only 860 million, so it's not that big, but it operates in lots of countries because they've bought local players to get the client bases and so on. Mm-hmm. It's been family owned, so the father, who passed away, I believe, the son runs the business now, so they're large family founder mentality company, which we like. Passes all of our filters. It's currently on a PE of 19 and the share price is about $4.29. It's returning 18% per year on default, but about 4% on a margin of safety at the moment. So the PE is in the bottom quartile, which is good. I would say, it passes everything, so I'd have to say it's potentially a buy, but I'd want to get at least 10% on a margin of safety. And to get that, you can only pay $3.26, which is about $1 below where it is now. Now, will it go down another $1? Could easily over the next couple of months. So I would say it's a buy if you could buy it at about $1 cheaper. Okay,
so this is one of those companies that if it gets beaten down along with the broader market, that's when you start to look at it.
Then the risk reward's very good. Yeah. By the way, if it goes down another $1, your probable return's about 20% per year.
Pretty good. Shawn Partners as a buy, Ord's a buy, UBS a buy, Morgan Stanley overweight. What do you make of the company?
It's a relatively new one for me. So I've done a bit of research on it and looked into it. I'd be interested to actually know later on how many companies Mark's got at the moment that are in that area of safety where you feel comfortable to buy them, because this market is so elevated.
Not many.
No, I didn't think there would be money. Or many. I think the market's pricing Hansen as X growth, and I think they might be a bit off the mark there. I think the risk reward's a little bit better, so I've got it as a buy. I like what I read. I think that they're some predictable, resilient earnings. There's not a great deal about this company that I don't like. Obviously, the price is always at the moment when the market's made a new all-time high last Thursday. You've got to be realistic. Even after the last few days pullback, it's still quite elevated. I think the stock looks good. So for people that have asking questions, people that like the company, I don't see any reason why you wouldn't be accumulating.
There we go. It's a little bit reticent. Yeah, I'm not going to call it a double buy just yet, but you can take of that what you will. Ron, I think that was who wrote in about that one. Now, the second stock on the list is Hazer Group, and this is for Diana, who's given us a bit of context. She says, I'd like your thoughts on Hazer. Purchased them back in 2021 as a long-term investment and watched the shares slowly go down. Am I being impatient? And she does say that she loves the program. Thank you. Okay, so Hazer, we do actually get a lot of questions about this company because it's in the hydrogen space, because it's got this pilot program. I think a lot of people, want to believe in the story overall, but painful if you're watching not a lot happen or your shares retreating.
I think when you look at the more speculative end of town, you've got to have a reason why you bought the stock in the first place. So when you're saying you've been patient, the stock's dropped from $1.88 down to 31 cents. I would have thought the reason why you bought the stock is probably gone. One would like to think so. I see no reason why I can buy this stock in any way, shape or form. I would still call it a sell, but I don't know enough about it to say a sell, so I'd say neutral to sell. I hate to be quite so harsh, Diana, but I don't see any reason or any catalyst to change my mind yet. We've seen so many stocks in this catalyst space, hydrogen space, lithium space. Now, they've had a really, really torrid time. And you want to see companies making money, paying earnings, and if you have to buy it at a higher price, when it's kicked the goals, I'd rather do that.
Yeah, so you're happy to lose a little bit of the upside, and I've said this many times on this program before, for something to be proved up.
I'd rather lose a lot of the upside for something to be proved up, as opposed to catching a falling knife with no earnings, no prospects that I can see at all.
I can't imagine this passes the filters.
No, of course not. I would challenge the comment the viewer wrote when they said they invest. I bought it as a long-term investment. I would say what you've bought is a speculation. This is a because it's only the market cap's about 56 million. It lost 12 million last year. There's no sign of them making any money, and they've issued their share issuance has gone from in 2016 they had 66 million outstanding. Now they've got 175 million. So they've been mining shareholders really well, and what their prospects are, I have no idea. But until a company gets to the point where it has a business and is making money, I don't think you can't call it an investment. It's a speculation. Yep. So you can say there's nothing wrong if you want to speculate, but don't think of it as an investment. So where it's disappointing is if you buy an investment of a company that is doing really, really well, then it turns down. So that's then disappointing.
And that's going to happen sometimes. Yeah. So you want to have enough fat in your portfolio to deal with those, because we all get it wrong sometimes. Yeah. And if you're going to have your speculation, that's fine, but have it as the right proportional amount in your portfolio.
Yeah. Mm-hmm. And also the other thing I'd suggest is don't look at investments from the point of view of being in sexy areas, like saying, it's in hydrogen and I want to support a green agenda. Well, that's downright crazy from an investment point of view, because you then pay. And a good example is ESG. Some of the ESG funds, yep. They're on massively expensive because they're doing good in theory. But even then, you look at it and you go, are they really? changing the subject there a bit. But
I was going to say, we don't have time to get into that.
Try and look at the businesses on the merit of the business.
Yeah.
Yep.
You look at the numbers, all right, and how they all add up. All right, let's go to the third stock of the day, which has been picked by you, and this is Objective Corporation, and this is for Stan. Stan, thanks for watching, thanks for listening, and I will remind you that this is information only. This is not financial advice for your own personal circumstances. So if you need to get advice, at the very least, do your own research. Mark, OCL, Objective Corp.
Yeah, interesting business. This is another one that we've looked at over the years. Not a lot of our members own it, and the reason is the founder CEO Tony Wall owns, I think, 65%. So there's very, very high ownership of the founder, which we don't have a problem with. But years ago, he was doing share buybacks, and then he wasn't selling any of his shares into the buyback, so his shareholding was increasing. And we thought at the time he was basically privatising it. So that turned us off. Yeah. The numbers were all great. It's a great business. What they do is they mainly service government, federal government primarily, defence primarily, and they do all the document management and security and tracking, making sure that all the stuff, who gets to read it, who doesn't, it's all that. So very, very sticky business. We'd call that a trapdoor mode. So once they're in it, you can't get out. And one of our members who's ex-defence in Canberra said it's a horrible system and he hates it, but it doesn't matter because the point is they're locked in and they just keep getting more and more revenue. So very, very high consistency of EPS growth rate. Currently, earnings growth is 25% a year over 6 years, 94% stability, which is really good. Return on equity is 28, so it passes all our filters. We're showing it returning 36% a year if they can keep going at their current trajectory, and 7 on a margin of safety. So that margin of safety takes the worst view over the last 6 years on every metric and then extrapolates it. We don't do discounted cash flows. So that's a pretty good risk reward. It's on a 45 PE, but that's at the very bottom of the green. So that's the lowest PE it's been on for a long time. So its normal range is between 60 and 78, which I'm not saying that's fair, but at least their EPS growth rate at 25 justifies a higher PE compared to worst is having a high PE with low growth. That sort of really gives me the heebie-jeebies. I'll say it's a buy.
It's a buy. What do you think of Objective Corp?
How old is Mr. Wall?
Good question. Probably my age, 68.
Okay. That's an interesting stock holding. Wonder how hungry he is for the business, because he's obviously done a very, very good job so far, because at some point in time you might have an overhang. I look at the stock, it hasn't gone anywhere for 12 months. During that time the market's gone up nicely. It's gone sideways. It's a good, solid business. I most definitely would call it a neutral to a buy. Everything Mark said makes total sense. It is a good, solid business. It's got a moat. It has got sticky growth earnings. All those things are facts. I'm interested to know if I could justify the PE with a man at almost 70 years old holding that much of the stock. Does he want to start selling down at some point in time for the family? Retirement phase. That will bring a lot of stock on compared to the natural free float at the moment. So I'm going to call it a hold. But it would be on the buy side of a hold. I hate to be sort of treading the fence there.
Yeah, no, that's okay. That's an interesting take on Objective. It's a sell for ORDs. They just point to the fact that gross margins stopped declining in the first half, countering a 5-year trend. And Shawn Partners says a buy, Morgan's an add. So that's for you, Stan. Thank you for writing in. Now we get to the mining space. This is for Sarah. Chalice Mining, CHN. Shawn?
Interesting story this week. Obviously, they're looking to tie the deal in with Mitsubishi. Not always a big win when companies do tie-ins with Japanese companies. We've seen that in the past. I think it's something they had to do.
Chalice is the one, just remind me, that has that big prospect that's quite close to Perth.
Yeah, it's critical minerals. Nickel, of course, is not very topically positive at the moment.
No.
So at the end of the day, I can't go beyond calling it neutral. I mean, what I don't like is the talk about the tie-up with Mitsubishi. There's no actual valuation being put on the stock.
That often happens.
So talk is cheap.
Yeah.
It's a bit like me saying, well, I think the stock's worth $2, not $1. If I'm not putting any money behind that, it means nothing. So I really can't go beyond being neutral. What they're trying to do, what they're achieving, it's what they set out to do, it's what they said they would do. So that's good. But it's in no way means I'm going to buy the stock.
Okay. Look, that chart's pretty painful over the past year, reflecting what's gone on in terms of key commodity prices. Would there be anything in Chalice?
Well, it doesn't make any money. It does. There's no income, no revenue. It's been going for 10 years. You know, I look at these companies, when you see these companies just continue losing money, and they had a negative 35% return on equity, which basically means they lost 35% of the equity in the business in the last 12 months. You know, so I mean, the Mitsubishi thing is meaningless. You know, they've got to have a story, because if they don't have some story, how are they going to get anybody to buy it? The share price, I wouldn't touch it.
No, there's no reason. If I had
it, I would sell it, because there's no reason why you were looking at this. You'd say, "Oh, I have confidence in this company; it's going to be really good."
Okay.
Well, there are stocks on the market at today's prices you would buy. So by
absolutely.
definition, every neutral one could call a sell.
Exactly. Okay. We're going to call that a sell. All right, the fifth stock of the day, Bellevue Gold. This is for Arnold. I might just go to you on Bellevue Gold, because you and I have had a lot of conversations about gold miners.
Yep.
Is this one of your picks?
Absolutely not.
No, why not?
No. Well, they've just raised $150 million at $1.55. Stock's trading, where is it today? $1.27. So a few weeks later, the stock significantly below the cap raise.
Yeah.
The cap raise was to pay down half its debt. You've now got a brick wall of selling that's likely to come up if we get back up there in any time in the near future. I like Newmont. I like Evolution Mining. Buy the stocks that are making a profit, that are paying a dividend, that got some upside. This is a company that's trying to get itself out of a mess. That's probably a bit harsh, but it's just not good enough compared to the opposition on the space.
Mm-hmm. So that's a sell.
Yes.
Let's get to Bellevue Gold. Mark, a view from you and the Teaminvest piece?
No, I concur with Shawn. They lost 24 million last year, but the big thing that puts me off, they don't make any money, so they've never made a profit. I don't think, have they? They've never made a profit? I don't think so. The shares outstanding have gone in the 10 years from only 1 million to 1.1 billion shares outstanding.
So I see you having to check that, because you almost can't believe it.
Yeah. Like, am I reading this right?
Yeah. So, I mean, they may say they're called Bellevue Gold, but they could be called Bellevue Shareholder Miners.
Yeah. Okay, Bellevue, that is a sell for both of my guests. I think we can just keep my notes pretty snappy on that one. All right, we are halfway through the companies that have been picked by you. Let's summarize what we've learned so far. So TWE, so Treasury Wine Estate, risk reward good in Shawn's view, not fantastic, but he's long Treasury Wine Estates, and he said that you can buy it at these levels, prefer to get it cheaper, but can buy it. Shrinking to greatness again is the question Mark puts to the company, and it's on a 25 PE. So he reckons that it's just too expensive for what he calls a turnaround story. Okay, let's get to Hansen Technologies. It is potentially a buy. So it's not today a buy, because Mark would prefer to get it at around $3.26 rather than $4.26, but he does like the founder mentality. It is a buy, though, for Shawn Hickman. He actually likes what he was researching and looking at this company. So predictable, resilient earnings are worth paying for sometimes. Hazer, both of my guests just say, neutral to a sell. This is not an investment. It's not making any money. There's no key catalyst on the horizon that Shawn can see. So why own the stock is the question. And Mark says the same thing. It's speculation. No sign of any money coming through. He'd sell it. Objective Corp, it's a buy for Mark. And Teaminvest, it's got a trapdoor moat. There you go. There's a new one for you. And neutral to a buy for Shawn for Objective Corp. Strong growth earnings, a little bit curious, I suppose, as to the founder owning 60% shareholding in the company around about there. So it's a hold for him. Chalice Mining, hold for Shawn. It is a sell for Mark. No reason to hold it. And it's a sell for Bellevue Gold from both of my guests. But kind Shawn Hickman from Market Matters has given you a couple of bonus buys in the gold space. Newmont Mining and Evolution Mining, although I'm not even going to bother asking Mark for a bonus buy in the gold space, I don't think.
Cold shares.
Yeah. All right, let's get to our new portfolio read. Okay, so here we go. Each month we put stocks that have been picked as a double buy on this program to our investment committee. Well, the latest episode will be posted online just after market close. You can also watch it, of course, on the live stream. So if you miss it, it will be on the website series, the investment committee. We also will share it on socials. So let's check in with the portfolio update going into August. Drum roll, please. The committee sold Woolworths, replaced it with IPD for a 5% weighting. The company also sold, committee I should say, sold Pats, wow, and replaced it with Northern Star Resources for 5%. And CSL was trimmed 3%, and they used that to put it into mineral resources. That's some good changes. You'll need to listen to the episode to find out the reasons why, because I do remember that the committee took out Evolution maybe a couple meetings ago. So interesting they put in Northern Star. So far, the fund is up 27, roundabout there, % on a cumulative return basis since its inception on March 2022. So we will continue putting these companies to our investment committee, none from this program, though, at least not yet. Yet. Okay, let's see what's coming up then. Corporate travel, okay. ARB Corporation, Super Retail Group, Lendlease, and REA Group. Quite a different grouping of stocks for the second half of the program. So let's get to first stock on the list, and this is Ryan, and this is a question for Mark. Saying recently Mark said that corporate travel was appearing very interesting at around the $13 mark. Looking for Mark's thoughts on this price point. He's ridden it down from $16 and is starting to feel the short-term pinch. Yeah, you've been a long-term believer.
Well, I sold out in the beginning of COVID.
Yeah.
Before that was one thing I got right. And then I bought back in 220. But the share price dropped from $23.43 to $4.20 in COVID. That was the March 20, and that was clearly when it was a bargain. What shocked me was how fast it went back to $22. So then it's been, if you look at the highs since COVID, 22.88, 26.34, 22.04, 21.49 in the trailing 12 months, now 12. Now those prices were ridiculous because it was virtually going back to pre-COVID pricing when the business had no earnings and was having to come back from total shutdown and all the drama. Now that's taken longer than I would have expected, and I'm sure by their standards, longer than they would have expected. And the industry, the airline industry particularly, has taken longer to come back because they lost pilots, planes were mothballed. It's the disruption from COVID has had a long tail. So now what corporate travel did during COVID is they didn't have any debt when they went into COVID. They were very strong. They cut costs straight away. They did a capital raise, but the capital raise was to make a couple of acquisitions. So they bought
big one in Europe, right?
Big one in the US. Travel and leisure was the big one. Is one in Europe as well?
I think so.
Anyway, I think it was two in the US that I know. And then what they did is that has effectively meant the business is 50% bigger. These companies, corporate travel, have worked with for years. So they knew them. It's not like they just bought something. This is an absolute bolt-on. Geographically supports what corporate travel's business is in the US, from a coverage point of view. So it all strategically makes a lot of sense. Now their earnings they're back to profit. So they're profitable now. And their earnings, I think the last earnings was about 80 cents. Pre-COVID, their earnings were 77 cents. The last year before COVID. So their earnings are back to about pre-COVID, but they should be nearly double because the business is actually the machine, and if all things are equal, they should be about $1.60. We're giving them $1.10 for next year, and growing then at 15%. They were growing at over 20% up to COVID. This is a quality business, very, very good track record. Just totally disrupted with COVID. Now that it's down to $12, it's now at a price that's realistic to give you a 20% return going forward on a 5-year horizon. So we invest on a rolling 5 years. So I would absolutely say it's a buy now. I'm actually buying more, and hopefully it'll go down a bit more over the next few days. But I don't know, it's picked up already, has it today? I'm not sure.
Yeah, well, okay, so you're saying to our friend who's written in.
Don't worry about the fact that it's
Ryan,
gone down a few dollars.
It's okay. You're saying hold tight. Okay, so if you own it, hold it, but you're actually adding to your position. Got it.
I think accumulate's the word.
Okay.
Not for me, for Mark.
Yeah,
Sorry.
right.
I think I loved what they did in COVID.
Yeah.
They raised money to buy cheap in businesses that was
It's very clever.
very smart.
Yeah.
They weren't being forced to raise money to stay afloat. There was a big, big difference there, and they bought decent, sensible bolt-ons, to use Mark's phrase. Yeah. Very impressive. They, at the moment, have got some short-term news-grabbing headlines. You've got riots in the streets in the UK, quite ugly riots in the street in the UK, quite shocking. And they are sort of having most people just take out all of the European earnings from the government contracts. To me, that could be a good thing to give you the opportunity to enter into corporate travel, because they are a quality business. I totally agree with Mark on that. So to me, that'd be an accumulating to weakness. We've been watching the stock. It's hard to get too excited right now in the cycle, week to week, day to day. But do I think the stock will be trading a lot higher in 3 to 5 years' time? Yes.
That's for a long-term investor.
Well, we are investors as well. You know, we're active investors, so we're a bit different to Mark. But the bottom line is we're investors, which means looking forward, do I think the stock will be higher? The answer is yes.
Yep.
But the market was way too optimistic.
Oh,
Having it priced up in the 20s when they had no revenue was crazy.
Yeah. Okay.
So 16 wasn't too bad, but you know, that was then, and now it's realistic. That's the point.
Okay.
Yeah.
So you are not buying today, though.
No, we're not. I mean, the thing is, we run real money portfolios like Mark, so you only can buy a certain number of stocks. You can't, but just because you think it's a buy doesn't mean you can buy it.
Yep.
There's a difference there.
Okay, but for the purposes of this program, you
It's a
wouldn't
buy.
be
We like to buy. We often stagger into stocks. We might buy a third, because we're not into picking bottoms. Everyone likes to try and do it, but you don't do it. You know, mathematically, you're not going to do it, especially with things like the Japan happening. So to me, it's at levels where you can start to accumulate.
Yeah, that's a buy. That's a buy, isn't it? From the point.
It's a buy.
That's right, it's a buy.
I'm calling it a buy.
Yeah.
Okay.
I'll stop talking.
Just trying to encourage you there.
Get off and just say bye.
All right. And we know that, you know, this doesn't mean that Market Matters is going to go out necessarily and buy any of these companies, but
Well, I don't speak for Teaminvest, but our members do what they want to do.
Yeah.
We do have a fund, and it's in the fund.
Yes. Okay. Seventh stock of the day. That's not the seventh stock, is it? No. We're on the sixth stock. Yeah. Maybe not. All right, let's get to the next one that's showing up in my prompter. Yeah, there we go. We've got ARB Corp, and this is for Andrew. No context here. But yeah, this is often talked about as a quality company. Shawn?
We thought they did a really good report in February. The stock reacted accordingly. This is a recovery play though. The stock's had a really, really tough time. So you're not showing a huge amount of the time on that factor, but the stock has come down an awful long way.
We can show the 5-year.
Yeah, show the 5-year. Stock's come back an awful long way. We regard this as a recovery stock that we would consider, and I call it a buy. We like it. We like the result that came out in February. Obviously, another one's going to be coming out soon, and you know, we think this is a great opportunity to. If you want to buy beaten up stocks, this is one that we regard that would cross our filters. Generally, at the moment, we're looking to buy quality stocks that have come back with the market. I do reiterate that point, but I think this stock is on the turn.
Okay.
In the right way.
Okay, good. Not worried about its exposure to the consumer.
ARB's been a wealth winner for us forever, since we started. So, and a lot of members have made very, very good returns on it over time, but we don't trade. At the moment, it's on a 34 PE, which is in the red. So for us, it's too expensive. I wouldn't buy it now. It's a hold. It's definitely a hold. So it's an absolute quality company, a founder-led, very, very good numbers. The question is the EPS, and the EPS picked up during COVID. They actually had a very good COVID, post-COVID, which, who would have thought, that everyone was going to go driving four-wheel drives around Australia. These are the consequences of COVID. Yes. But they did very, very well out of that. Then it's dropped off somewhat in 2023, financial year 23, which is when the share price came down, which is understandable. And now it's sort of flatlining a bit, going up a bit. But it's hard to expect them to be able to maintain the higher rate post-COVID. So it looks like it's heading back more to their more traditional return, which I'm not surprised, which is fine. And we're showing it returning 14% a year if you bought it at the current price, which is okay. On margin of safety, it's only 2.7 though. So if I wanted to get 10 on margin of safety, which is basically my absolute minimum, I could pay 27.61, and it's currently 38. So is that feasible? Absolutely.
You think so?
Yeah, it's possible. Well, it depends on what happens. It's not going to do it on its own. But if this problem we're having at the moment goes on another couple of weeks, or we have more of a drop in September, anything's possible. So what happens whenever the market has a rout like that, it tends to bring everything down. So even if you look at the selling on Friday and so on, a lot of them were similar. Down 2%, 3%. Yep. It's not nothing to do with fundamentals.
No, but it's because the selling is futures led.
Yeah.
And the basket hits the whole market.
Oh yeah, I understand how it works, but I'm just saying, if you want to own ARB and you're saying that you wouldn't want to own it unless it gets down to $27.
I'd buy it at 27.
27.
Yeah, that's what I'm saying. So it's to hold. Do I think it'll get down to 27? It's possible. That's all I'm saying.
Yeah.
I don't know.
Yeah.
In fact, there may be, I won't say blood on the streets, but anything could happen at the moment. We could have a blow up in Europe or anything. We could easily have a big rout, and then that's when you get the big opportunities to position into really quality companies like this at low rates. Mm-hmm. Then you get the decent 15-20% return.
Mm. How much attention, how much time do you spend on earnings at earnings season, Mark?
A lot. Mm-hmm. Yeah. So what we do is we run a triage twice a year, straight after earnings season, where we look at all the companies we're interested in and what they reported. What was what we expected? Where we write in our predictions, because we predict earnings 5 years out on the companies that we can predict, which is the minority number of companies. ARB we do. And to see, is that right? Any scuttle, anyone know anything, anyone learn anything? And then we discuss it all and decide whether we want to do any more formal work on it or not. Mm-hmm. Yes, we do. Okay. Earnings is fundamental to your returns. Mm-hmm. So what we're interested in is, what we really like is 10 to 15% growth rate if possible, and with high stability. So they'll be consistently doing it.
It's a simple game. Earnings drive share prices. Yeah. They might not week to week or month to month, but they drive share prices. Mm. Yeah. Mm. Yeah. I actually wrote down with ARB accumulate below 38, so we're more aggressive than you.
Yeah, because I'm just questioning it because 27. Yeah. There would have to be something really
remember,
wrong.
Nadine, my problem is I want to get my problem is I want 20% return. So therefore, to get 20% return, I've got to buy really well.
Yeah. I'm just fixing Sean's
I always tell my son not to say I want.
I would like.
Okay.
Okay, I would like to get on with this program, and the next stock that has been picked by you, our viewers, is Super Retail, SUL. This is for Oliver. Now, I ask about reporting season, Shawn, because we're obviously, getting closer to the thick of it. One of the more interesting things that will come from this reporting season are some of those updates from the retailers that tell us how trading is going in the first 7 or 8 weeks of this new financial year. So, the likes of Super Retail. What are you looking out for in these results?
Okay, you've flicked from Mark to me. You started off on Mark then.
Did I say Mark? No?
You did so. Doesn't matter.
Sorry.
Absolutely
Shawn, looking at you.
Well, the retailers are going to be cautious. I think some of the retail numbers coming through are pretty average. I think they should be. Every time I've gone looking for anything to buy for our house over the last 6 months, because we've done some renovations, I've been bombarded with offers in the following few weeks, far more than you'd have had in a few years ago. Yep. Things are fairly tight. So Super Retail, we own it in our active income portfolio. We own JB Hi-Fi in our growth portfolio. To us, they're the two best retailers out there. They haven't necessarily been the best two performers, but they're our favourite two retailers. They're going to report. Let's wait and see how well the market. JB Hi-Fi last week all-time highs. It was getting pretty rich up there. I think JB Hi-Fi in particular, I'm going off piece here. They probably do need to come out with a good number, or their stock can come back a long way because it has run pretty hard. But we do believe it's a quality operator, and we do think it will deliver some good earnings. Okay.
So Super Retail, what's your rating? Buy, hold, sell today?
Buy.
That's a buy. We're on a roll here in the second half of the program. Retailers. And you will also get a right of reply to JB Hi-Fi, because I know you guys have held that for a long time, correct?
Yeah. No, I agree with that. Yeah. Super Retail has been a wealth winner as well. We like retail, and we've done really well on retail. So it's hard for me to be critical of the area. And I have never owned Super Retail personally. Quite a few members do. It's not our favourite retailer. Our favourite, if you choose a favourite, is probably Nick Scali, and JB Hi-Fi, and then AS1 probably. But Super Retail's in there. The only problem with Super Retail at the moment is we're returning 13% a year, which is pretty good at the current level. It's on the red from the PE point of view at $15. So the PE ratio at the moment is 12.9. This trailing PE. We'd want to buy it in the green, which is just below 10. And that gets there every year. The bottom quartile of the PE range happens every year. So it's like this is not ambitious now. So for me, I would say it's a buy. It's a hold, but it's a buy if you could get it for $12.35, which is about $2.90 less than where it is now. Will give you a 10% return on a margin of safety, and that would give you close to 20 on a default setting, which is the likely one. So default's what we think it's likely to happen if all things are equal. And any short-term view of the market at the moment about tightness of retail and stuff, all that's a bit academic from our point of view on our time frame. And the other side that people forget is that we still have massive increase in population and young people coming in, and they'll spend money on this stuff and so on.
Okay. Now, JB Hi-Fi, so you...
JB Hi-Fi I think is better. I mean, I can tell you what the price is, JB.
Just to clarify that when Mark's looking at that, we own Super Retail in our active income portfolio and JB Hi-Fi in our active growth.
Okay.
Slight difference there.
Yeah. So see, we got JB Hi-Fi returning 22% a year on default and 8% on a margin of safety. So that's so significantly. But it's on a 15 PE, but JB Hi-Fi's earnings are high there. It's averaged 22% over the last 6 years, which is pretty spectacular. Yep. Now I'm not going to say it's going to go 22 going forward, and that's why we use a margin of safety. And our margin of safety for EPS is 8.3. So it's which is a big difference.
Yep.
So that's why if you buy it at 10 on a margin of safety, you're looking really good.
So any wobble come reporting season,
Yeah, well, the PE is at the top of the red at the moment. I totally agree. I think there's a very good chance you'll be able to get it cheaper.
Yeah. Now, Nick Scully reports on Friday, I think. Yeah, so you'll be looking forward to
We'll be very interested in that.
Yeah.
Main thing about the UK, because they've made the acquisition in the UK, we've got mixed feelings about it. It's not that big, but it's a significant management distraction in that it's literally the opposite time zones for the UK, and the supply lines are all different. There's a lot of moving parts in there that they're going to have to get right. It's a little bit like when REA bought into the US. We decided to stand back and watch.
But I liked it because I like the fact they did it in a very small way.
Yep.
And it gives them the opportunity, if they have to write it off, it's not a disaster.
No.
And they can, if they can get the right management in place, so it doesn't become a distraction.
Yep.
It can be fantastic.
No, you're right. I'm doing a glass half full.
Yep.
And we've always liked Nick Scully, and I don't know of any members that have sold. I've got shares, and I haven't sold any. But I'm saying we're very interested to see what they report. It's probably too early from the acquisition point of view to get any numbers out of it. But I suspect that it'll be difficult for them not to have challenges. And as you said, they've got rights in the UK, and there's the economy's not going that well over either. So
but it's a huge market.
True, it's four times bigger than Australia.
Yeah, it's a massive market. Yeah. They've gone in, they've bought cheaply. It is a different end of the spectrum.
I'm a fan.
Yeah, absolutely. I think that the way they've tried to get penetration into the UK is quite exciting. It's prudent. I like that word. It's a prudent acquisition. Because we see a lot of acquisitions that are not prudent.
Yeah. All right. Well, maybe one of the Scullys will go over to the UK so they can just, have a family WhatsApp group as they sort this UK business out.
Nick Scully's on a 14 PE.
14.
Yeah, which is okay. It's on the red.
Yeah.
I'd like it a bit cheaper.
Everybody likes everything cheaper.
Yeah.
I'd love a sale too. Yeah. So anyways, let's see what else we can talk about toward the end of the program. But let's get to the ninth stock on the list, Lendlease. This is for Bob. Okay, so talk about shrinking to greatness, you think, Mark?
Yeah. Well, look, their 2014 earnings per share were $1.43. Now they're 3 cents. And if you look at the history of 10 years, it's literally been 10 years of decline with a bump up during COVID, straight after COVID. But it's been down, 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 down. I don't know how anyone can get excited about businesses like this. It's got a return on capital of 0.7 of 1%. And obviously, the debt's not too bad considering what they are. But 0.9% yield, so you're not even getting a decent dividend out of it. So I would, if I had money in this, I would sell it.
Okay. Sell, and no reason to get into it is what we'll take away from Mark Moreland from Teaminvest. What about you, Shawn? I mean, now it's come back to Australia, divesting its assets overseas. I mean, has the potential changed?
It's a dismal story. Without doubt, as Mark pointed out the numbers. I used to work on the trading floor back in the 89s, 88 time. And it was regarded as a blue chip stock then.
Absolutely.
And it's just gone one way ever since.
So was AMP, remember, at the beginning?
So was there's a few other stocks I can think of as well, But it was and Commonwealth Bank wasn't even floated then. So, we're going back a bit. I'm showing my age. Okay, so they have started selling off some assets. They recently sold off the US military housing. They got more than book value for it. I think it's just going to bounce around, up or down 10% either side of $6. It's a trading stock. It's not an investing stock. Is it a recovery stock? It will, if you buy at the right level as a trader, I'm sure you can make 20 or 30% out of it. But to me, this is a market where you really want to be, and I wrote about this morning for Market Matters with James, you want to be investing to sleep. If you're holding CBA, it's going to pay you a fully franked dividend. It might be quite rich in price, but it's going to be there tomorrow paying you a dividend. Some of these stocks, they could halve if we go into a really tough recession. I don't think this is the right time in the cycle to be playing for recovery stocks.
So that's an avoid or a sell?
Yep.
from Shawn. All right, let's get to
Avoid.
Avoid. Got it. Number 10 on the list, and this is for Caroline. 10th stock is REA Group. They report, if it's not late this week, I think it might be Friday, it will be early next week. Shawn, REA Group, you like it?
It's a quality stock which we sold too early, which if we followed all of Mark's direction, we probably still would be holding. It's a quality stock, and we had a really, really good run out of it. It hit our target, we took some profit, and it kept on going and made us look silly. So it's a quality operator. I've made a note here that we'd love to buy it back under 180. I'm not sure what it is today. It's probably lower than that.
Yeah.
No, 190. They've come out recently and they've launched their Lux listings. The initial, and it's very early days, the initial feedback is positive from that. So this is a quality company which you buy into dips.
Mm-hmm. Which you might get is what we've determined.
As I said before, this is a good time to buy stocks you wish you owned.
Yeah.
And I wish we still own this.
Yeah, okay. Well, we'll keep an eye on REA Group for the team at Market Matters. You hold?
Well, we like it.
Yeah. Okay.
Not many members own it, and the reason is we were put off 15 years ago when we first looked at it by the Murdoch controlling interest in it, and the argument always was, well, Rupert's got a controlling interest of REA, and therefore he may do capital management things which won't be in the interest of shareholders. I mean, not meant to do that, but he also controls the board and all the rest of it. So that put people off. Look, none of that's transpired. And the company's been an excellent performer, and the members who did buy it have done astronomically well over the long term. So it's currently the problem with it. The market recognises the quality of the business. They are the dominant player in real estate. Domain has spent millions and millions of dollars trying to fight them with Fairfax behind them and so on, and have totally failed. Really, the REA, it shows you the power of a network moat. Which means because they've got all the listings, everyone goes, all the buyers go there to look for the listings, so the advertisers have to advertise there if you want to sell your house. So it's a mutually beneficial symbiotic relationship, and they dominate it, just like Apple does with its iPhones network, same thing. Anyway, it's not going anywhere, so it's a quality business. The problem is it's too expensive. The earnings have been growing at 10% with 90% stability average over 10 years, which is fine. Now, how much do you pay for that? That's the question. At the moment, it's on a trailing PE of 67, which is in the red. Now, it's always had a high PE, which is the problem with some of our well-known good companies, because everyone knows they're good.
Yeah.
It's just too expensive. And the return you're going to get at the moment on a 67 PE is about 8% on default and -3 on a margin of safety, which, look, I'd say if you could buy it for, go back to my 10% on a margin of safety argument, which I've been flogging today.
Yeah.
You couldn't buy it for more than 172.
I said 180. It's not too. I tend to be more on the richer side
So
than you.
I'd say it's a buy at 172. Otherwise, it's a hold.
Okay.
It's also, and I think that's an important point, it's a fairly liquid stock.
Yeah.
So when we get big, bad days like we did yesterday, it can fall further, because when the arbitrage hits that stock.
And it's 25 billion market cap as well.
Yeah.
Which is surprising, isn't it? That it's so illiquid.
Yeah. Well, there's a lot of people sitting on profits that don't want to pay the government any tax.
Teaminvest members.
True. That's right.
So it is a quality company, but the time to buy is not now, I think, is the scenario there. Before we get to our little bonus question with my guests today, I'll just refresh your memories as to what the verdict was on some of these stocks from earlier. Corporate travel, it's an accumulate, it's a buy for both of my guests. A quality business, accumulate into weakness, so Shawn does say. ARB, again, another quality wealth winner in Mark's terminology. It's a hold, though. He'd want to get it a bit cheaper. It's a buy, though, for the team at Market Matters. It is beaten up if you look at historical context, but you could maybe get it cheaper. That seems to be the theme of the day. Super Retail, it's a buy for Shawn, and Market Matters. I think that's what's throwing me, the Market Matters and the Mark thing. But it's a buy for Mark here beside me at around $12.35. Right now, it's a hold. Okay, so we had a good discussion around the retailers. Go back and listen to it if you need to do so again, but some commentary on JB Hi-Fi as well. Look, Lendlease, it's an avoid in Shawn's view. It's a trading stock, it's not an investing stock, and for the purpose of the show, we're talking investing, and it's a sell. Mark just doesn't understand how anybody could get excited about a stock like this. And REA Group, you heard what the guys just said about it. It's a quality company. Today is not the day to buy it. Okay, so yesterday Kashi wanted to know from his guests, if you've been waiting for a session like yesterday, for a 2-day selling that we saw between Friday and Monday, what company is on your watch list? Something you really want to get, you've never been able to get set in because of the price. So what would be top of your list, Shawn?
Well, I've mentioned one today.
Yeah.
Well, we have owned REA before. I like REA. Wish you'd give me a few minutes to think about this.
Okay, sorry, I thought you had a heads up on that.
No,
Mark,
no,
I'll go to
there's
you.
too many. There's too many. But I'll let Mark go first, then I can disagree with him.
Yeah, okay, I'll probably go to NVIDIA, which I'm a shareholder on,
Okay.
and I've done really well on NVIDIA. I'd like to buy more at 95. It's currently come down to 100. It's come off pretty heavily. It's come off from 139, I think, down to 100.
Yeah.
So it's getting quite close to me buying more.
Would you ever be tempted at 96, 97?
Maybe. We'll see what happens over the next few days.
Yeah.
And the other one, if you're an Australian one, would be PME, Pro Medicus,
Yeah.
which I did own. I owned it before they became successful and
bad.
gave up. So long time ago.
Yeah, but I think this is the second time Pro Medicus has come up.
Yeah. Well, they bought a German company, which is the technology that's made them.
Yeah.
So I sold out when as they bought it.
Yeah.
Because it had gone down. It's terrible. Anyway, I'm probably the only person who's lost money on Pro Medicus. A lot of our members have got it.
Yeah.
It's on a current PE of what is it actually at the moment? It got up over 200. Which is, clearly absurd. Its EPS growth rate's running at 36% with 95% stability. So we believe it'll be able to maintain that for the next 5 years, based on without going into a lot of detail. It still can't pay 200. It's 196 PE, so it's come off a little bit. So for me, it would have to get down to $107. It's currently 130. I'd buy some of that, and that's a PE of about 7. What PE would that be? That'd be a PE of 160. Right, no, 120 PE.
Again, he's thinking, what have I just said?
Yeah,
But
yeah,
okay,
right,
$107 for Pro Medicus. Yeah. Okay, Shawn, I'm sorry, but any
that's
company
okay.
you're just, you'd
I'm
love to get cheaper.
Okay, so NVIDIA around $100 I think is definitely an accumulate.
Okay.
I think it's actually quite an interesting scenario. Last time the market had some real wobbles over the last couple of years. Investors have bought most of the big seven. Because the US big tech stocks are still cash cows.
Yeah.
They're cash cows a bit like our miners were a few years ago. They make an awful lot of money. What people are scared about is how much they're going to pump into AI now and what are they going to get the return on it. But I think they're going to wake up and say, well, hang on, these companies are still making billions and billions of dollars. They're buying back shares at astronomical rates.
Yeah.
I mean, some of the buybacks that go on in the US are just hard to fathom. They could buy out CBA without even blinking, with how much money they're buying back. So I think a couple of those, read between the lines, read between the companies you think will get the best return out of AI or might not spend too much until the gateway opens. Yeah. NVIDIA's slightly different. They're making the chips, they're making the money. Around $100. I think it got below $100. It closed there last night.
Yep.
I think it's certainly an accumulate, without a shadow of doubt in my mind. But coming more locally, we sold a stock 2 weeks ago, very close to the top, which when we sent out when we buy or sell a company, we send out emails and text alerts to our clients saying we are buying this now in our managed funds. So it's pretty transparent. Yep. And we sold Goodman Group and we said, we love this company, but we think from a valuation perspective, we think it's a sell. And we also think that the AI tech area is going to come off. We put that in a slightly more longer note. Well, of course, Goodman Group turned savagely in the last few sessions. Yeah. Gets back around $30. We will be accumulating that stock.
Oh,
we still want to own it.
Yeah. I was looking at Goodman yesterday thinking a lot of people might be starting to get tempted to get into Goodman if you weren't in it already.
What we've seen witnessed over the last few days is crowded trades getting unwound, whether it be the big tech stuff in the US, whether it be, of course, the dollar yen, which was the carry trade, which probably was the catalyst for the panic we've seen. So stocks like Goodman Group, it's a shame that we don't still have an excessive margin lending because it would probably be down there now because everyone would be getting out thinking it was an easy hold. But they could go a bit further. I think it was off 5.7 or 6% yesterday. So some of these well-owned stocks people will get out of and they'll give you great buying opportunities. So deep breath, Goodman Group around $30.
Thank you. Look, guys, I'm glad I asked. I'm glad you guys played along with that. And look, I thought this worked really well. You guys have got, a good little rapport going here. And thank you for being so generous and lifting the lids on both of your, how you do things, your your philosophies and your thesis and your strategy. So Mark, thank you as always.
Welcome.
For Teaminvest.
My
Shawn,
pleasure.
thank you as always for Market Matters.
Total pleasure.
Thank you for sending in your requests. Keep them coming. ausbiz.co/call picks. The investment committee is back, so if you want all of the details on which stocks we added, took out, why we increased the weightings to some and not others, we will release that new episode. It will drop, as they say, in the cool circles just after the COB today. Don't forget, we do have full coverage of the RBA's interest rate decision for you at 2:30 p.m. Stay with us.